So as I was saying in the previous video, I can't really have you guys do what we just spent, 9 videos doing. I guess 8, because technically the first one wasn't the Excel sheets. We can't do that on the exam. And there should be some kind of quicker way to get to this. Some little back of the page calculation that I can do, right, to get to the same basic result. Maybe it's not as accurate, but we make those trade-offs all the time in life, right? To where one of my best examples is the sunglasses I wear. Goodr. Goodr. They're running sunglasses. I mean, anyone can wear them. My mom wears them, and my mom has never run a day in her life. They were sunglasses made for runners who wanted sunglasses who wouldn't bounce when you run, who wouldn't slide down. Cheap. That way, if you drop them, lose them, have them stolen, drop them in a porta potty, leave them on the trail, whatever. Sit on them, crush them, step on them, leave them in a classroom, and they're there the next time you go back. Not that that has ever happened. And they look good. And so Goodrs, they will tell you they don't have the best technology of sunglasses. And then they'll also say, and you don't need it because you're not going ski on the Alps tomorrow, probably, to where you need to block the reflection from snow glare and everything. And it's true. Now the thing about Goodr is a pair of sunglasses only costs $25. Compare that to Oakley's or something, or Ray-Bans, which I don't even know how much those cost because I don't dare buy those. Although I do have literally over 30 pairs of Goodrs. I actually just ordered 2 more. I have a rack hanging by my door of nothing but sunglasses, and I don't even know where I'm going to put them because the rack is, of course, full. But the trade-off there is that, you get 95% of the quality for 10% of the price, right? It's a trade-off. And there's companies that exist in the market that will tell you they don't have the best technology. But you get 90% of the benefit for 10-20% of the cost. And a lot of people are willing to make that trade-off. Another company I've used before that does that is a company called Flow Wheels that made carbon triathlon wheels. They weren't the best wheels in the market, but they were a lot cheaper. And so we kind of want the same thing here. I know that's a weird kind of maybe analogy, but if I can have a tool that gets me 95%, let's say, of the information for only 10-20% of the effort, that's a good tool, right? That's a useful tool. Now, yeah, if I'm going to go do a complete analysis, if I'm going to go make a presentation, maybe I want, to have the full report done. But if I want to know if I even want to attempt the full report in the first place, maybe the tool is helpful. And so the goal of AFN, or additional funds needed, is what it stands for, is to give us a ballpark. Let me get to this number right here, wherever it was. The 117.10, let me get to that faster, please. Let me get there sooner. Let this be something that I could just break out a calculator and actually solve for. And so that's the goal of AFN, is to get us to that same place just much, much quicker. And a way that I can give it to you on the exam. So this is a problem you can expect to see on the exam. So we'll work one here. I'll post up some additional ones in the review, and then you'll also see it in the quiz. Someone just texted me. That's that guy from last semester. He was not that smart. Anyways. His text message, if you're curious, because why not, says, seems like 80%, maybe more, about finance is all about investing. Yes? No. He thought he was going to go sit for the CFA like immediately. And he was in the non-business finance class, so he was in the wrong class. And he didn't even bother to learn his financial calculator because he didn't think it was important. Yeah, he dropped the class. Anyways, okay, so here's what we're going to do. It says basic approach to AFN. Identify the amount of additional funding required by any additional assets due to sales growth, right? Because we know anytime we have sales growth, the only way I can grow is I have to go out and purchase more assets, okay? So we still have that same additional assets needed that we had in the big model. Identify the amount of spontaneous liabilities, it says, which reduces the amount of external financing that is required to support the additional assets. There should be a closed parentheses there. We'll talk about those spontaneous liabilities in a second. 3, or the third bullet point there, says to identify the amount of funding generated internally from net income that will be available for reinvestment in the company after paying dividends. Fancy way of saying retained earnings. And then assume no new external financing, at least for this company especially. And so the thing about additional funds needed is kind of the same that we saw before. It's like taking like the higher assets that you need minus the higher liabilities that you're going to have minus the higher retained earnings. Right? It's just saying these are the extra things you need to buy. These are the extra liabilities that are going to spontaneously generate themselves. This is the money that's coming from inside the firm. Whatever's left over, you got to go outside the firm and get somewheres if you want to fund those assets. So, zoning in on those really quick before we look at the actual formula. Ooh, excuse me if you heard that. I am so sorry. I hate when that happens, but I do not know how to edit my videos. Yes, I'm a gross and disgusting person. Areas to address. So I have to address my required increase in assets. Okay. This is basically assuming that we have no excess capacity, right? So no excess capacity. Meaning that if we want to have any more sales, then guess what? I got to go out and buy some more assets. And this isn't only fixed assets, right? It's not only that I have to go buy more equipment and maybe new buildings and whatever if I want to have more sales. I also need to carry more inventory. I'm going to probably have more credit sales, so I'm going to have more accounts receivable. I probably need to carry extra cash on hand just because I'm going to have more bills coming due every day as I increase my sales. Now, some firms will have that excess capacity to maybe where it's not such a linear relationship, but to make our lives easier, we can assume no excess capacity. They must grow their assets if they're going to grow their sales. Simple as that. The second one there, the spontaneous liabilities. Again, those are typically considered to be accruals and accounts payable. Right, that as I need more and more inventory to sell, to grow, I'm probably going to purchase more and more from my suppliers and purchase some of that on trade credit. Right, so accounts payable will just automatically kind of inflate and get bigger as sales grow larger. Same thing with accruals. I have workers working more to increase sales, or I have more workers. Either way, I'm paying out more payroll, right? And so I'm having a higher wages payable. I tried to combine the words accrual and common. Another common accrual is taxes payable, right? Because every paycheck, your employer has to withhold taxes from you. They're not immediately giving that to the IRS. They're holding on to it for a few weeks. And then, let's say every quarter, they remit it to the IRS. In the meantime, guess what? and they get to use that money. Same thing with your wages payable. I go look at my UTSA paycheck. Let's see, it's literally the middle of the month, right? So UTSA owes me half my salary for the month. They're not going to pay me interest in the fact that I have to wait all the way to July 1st to get paid for June. Right? There's never a line item on your paycheck that says, interest paid to Candy, because she lets us pay her once a month. And while we're waiting to pay her, we get to use the money we owe her to do whatever else we want. Accruals are free. It's literally free money for the firm. You don't get paid interest for the fact that your boss owes you money. You don't get to earn interest in the fact that the employer withholds taxes from your paycheck and doesn't immediately remit it to the IRS. Sucks. Now, accounts payable, not free. Right? We all remember the formula. Oh, God, let's see if I can remember it off the top of my head. That says it's something like the percentage over 100 minus the discount percentage times 360 over the credit period minus the discount period. Yeah, there we go. That looks right. That's that whole 210 net 30 thing. Okay, that's not free. Right? Because if you don't pay in 10 days, you pay the full amount. If you pay in 10 days, you get a 2% discount. It's not really a discount. That's good wording. That's good marketing. It's not a discount. Why would that give you a discount? No, that 2% represents a financing fee that you get charged if you don't pay in 10 days. And I always forget, I have a calculator right here. Let's see. The actual cost of that per year, if we do 210 net 30, is 36.73% APR. So that money's not free, but accruals are free. So firms always want to use accruals as much as possible because it's free money. If your employer could get away with only paying you once a year, they would. Trust me, they absolutely would, because they would get to use the money that they owe you all year long to do whatever they want and then just pay you at the end of the year. Most people don't do that, right? Even like us getting paid once a month is not common in not white collar jobs. My husband has worked, now he's in respiratory therapy school, but before that he worked construction since he was 18. And trust me, there was no construction firm that ever took more than a week to pay them. Not saying anything about construction workers, just saying that was the standard in that industry. But that's our spontaneous liabilities. That's what falls under that category. But we don't really have, like I said, much control over it, right? It's just going to happen kind of thing. The third thing we have to consider our additional funds needed is our addition to retained earnings. Again, we know that we have some control over that, right? Because we know we have two choices with our net income. We can keep it as retained earnings, or we can pay it as dividends. And so firms can't just come up with more net income, but they get to decide what they want to do with that net income. And if they want to decide to keep it, then that's going to reduce their additional funds needed, right? The more they keep of retained earnings, the less money they have to go find somewhere else. So that's kind of things we have to think about when we think about AFN. And so in the next video, we'll look at the formula. Then we'll look at an example. Then we'll look at the last topic, which is that self-supporting growth rate. Can't think of the wording. And then we'll be done with the chapter finally. It's a long chapter. It's all the Excel files take a minute to go through.